The stock market just hit an all-time high. The news anchor is smiling. The Chiron is green. If you felt absolutely nothing when you heard that, if it landed like news about a country you've never been to, you are not broken. You are not bad with money. You are not missing something obvious. You just weren't told what that number actually measures. The stock market is not a report card on the economy you live in. It never was. Once you understand what it actually is, the disconnect you've been feeling starts to make complete sense. When a news anchor says the market hit a record high, they are almost always talking about the S&P 500. That is an index, basically a single number that tracks the combined stock prices of 500 large American companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. Those names probably sound familiar, and they should, because in recent years, just those 7 companies drove 62% of all S&P 500 gains. 62% of the entire headline number came from 7 firms out of 500. The other 493 companies were mostly going sideways or down while the headline screamed record high. The number the whole world watches as a proxy for the American economy is, in practice, a scoreboard for a small club of technology giants, and most of the market is not in that club. Even if you imagine a perfectly spread out index that weighs every company equally, there is still a more fundamental reason the market does not track how your life feels. The stock market is not a measurement of how the economy is doing right now. It is a bet on how profitable corporations will be in the future. When investors buy shares, they are not saying the economy is currently good. They are saying they believe earnings will be strong enough months or even years from now to justify today's price. That distinction sounds subtle, but it changes everything. The market can go up while unemployment is rising. It can hit highs while consumer spending is tightening. It can celebrate while families are stretching paychecks, because the people moving those prices are not asking how you feel today. They are asking what corporate profits will look like next year. Your grocery bill is not in that calculation. The gap between markets and everyday economic experience got so wide, so fast because of 2008. When the financial crisis hit, the Federal Reserve did something it had never done at that scale before. It injected trillions of dollars into the financial system through quantitative easing, technical phrase for the Fed buying bonds and other assets from banks and flooding those institutions with cash. The idea was to prevent total collapse. It worked in the sense that the system did not collapse, but it also had a side effect that nobody fully anticipated at the time. All that cheap money had to go somewhere, and a lot of it went into stocks. Borrowing became almost free for large corporations. Companies borrowed, and instead of building new factories or hiring more workers, many of them bought back their own shares. A buyback works like this. A company takes cash, often borrowed cash, and uses it to purchase its own stock from the market. Fewer shares outstanding means each remaining share is worth more. The stock price goes up. The executives who hold stock options get richer. Nothing changed about the underlying business. No new product, no new hire, no new factory, just a financial maneuver that mechanically lifted the price. American corporations spent roughly $200 billion on buybacks in 2024 alone, moving stock prices upward without creating a single new job or building a single new thing. None of that means the market going up is fake or that record highs are automatically a warning sign. Since 1950, when the S&P 500 has hit a new all-time high, it has gone on to gain further ground over the following 12 months, about 80% of the time. Highs tend to precede more highs. The thing most people assume signals danger is actually, historically, a fairly ordinary launching pad for continued growth. The real risk is not the high itself. The risk is when prices rise dramatically faster than actual earnings, when investors are paying 25, 30, 40 times what a company earns because they expect everything to keep going up forever. That ratio, price divided by earnings, is the actual warning gauge. It is not a guarantee, but it is far more meaningful than the raw headline number. So when someone says the market is at a record high, the right question is not whether this is a crash waiting to happen. The right question is whether prices are still connected to realistic earnings or have floated well above them. The answer comes down to who owns the scoreboard. The top 10% of Americans by wealth own roughly 90% of all stocks. That means when the S&P 500 goes up, about 90 cents of every dollar of new market wealth flows to roughly 1 in 10 people. The other 90% of the country holds very little stock, and what they do hold is mostly locked inside retirement accounts they cannot touch for decades without a penalty. Meanwhile, the same period that produced these market highs also produced higher interest rates. Higher rates do not hit everyone the same way. If you own stocks and real estate, rising rates are mostly an abstraction. If you carry a car loan, a credit card balance, or a variable rate mortgage, those rates show up in your actual monthly budget. The average auto loan rate in recent years climbed past 8%. Credit card interest pushed well above 20% for many borrowers. Rent kept rising in most major cities. Asset prices went up for people who own assets, and borrowing costs went up for people who borrow. Two different economies running in parallel, described by the same headline number. Think about an auto worker in Detroit. His plant slows production because his employer is carrying debt that just got more expensive to refinance. His hours get cut, but his 401k, the retirement account he has been putting money into for 15 years, is up 15% for the year because it is invested in index funds that track those same S&P 500 companies. So on paper, he is wealthier. In the account he cannot touch without penalty for another 20 years. A number went up, but his rent went up 22%. His take-home pay this month is lower. The thing telling him the economy is fine is not his bank account. It is a number he has no practical access to right now. The market is doing exactly what it is designed to do: price future earnings of large corporations. The problem is that we have spent decades using that number as a shorthand for something much broader, something it was never actually built to measure. What should you actually pay attention to? The S&P 500 hitting a new high tells you something real and specific. Large cap corporations are forecasting profitable conditions ahead, and the institutions pricing those shares believe it. That is genuinely useful information, but it is narrow information. It does not tell you about wage growth. It does not tell you about small business lending conditions. It does not tell you whether consumer debt is sustainable. For those things, you want different numbers. Real wage growth, which measures whether your paycheck is actually buying more than last year after inflation. The unemployment rate combined with the labor force participation rate, which together give a fuller picture of who is actually working and who has stopped looking. Consumer credit delinquencies, which show whether people are falling behind on debt. Small business loan approval rates, which show whether the credit that fuels local economies is actually flowing. None of those numbers make it onto the evening news chyron, but they describe the economy most people actually live in far better than any stock index does. The stock market hitting an all-time high is a real event with real meaning, but its meaning is narrower than the way we talk about it. It means the largest corporations in America, as priced by large institutional investors, look profitable in the future. It does not mean your cost of living is going down. It does not mean wages are catching up. It does not mean the small business on your block is going to survive the year. The dissonance you have felt, that quiet confusion when you hear the economy is doing great while your own life tells a different story, was never a personal failure. It was a translation error. You were reading a score from a game that most people were never fully playing and wondering why it did not describe your team. Now, you know what the number actually measures. The scoreboard is real. The game it is scoring is just a lot smaller than anyone told you.